Hi, I'm Kep Kepner, CPA here in Dallas. One of the major tax strategies used by business owners is to defer income from the current year to next year, or to spend money on expenses and choose to spend it this year or next year. So you have an impact on your taxes by managing your profitability and managing when you have revenue and when you have expenses. Think about it. If you want to move your revenue to next year, okay, well, the IRS says if you collected as a small business, you got to count it this year. So does that mean that if you get a check from a customer in early December, you're just going to sit on it and not put it in the bank and say, well, I really didn't get it? Well, that doesn't work with the IRS. If they audit you, there's a term called constructive receipt. That means that constructively you have received that revenue even though you didn't put it in the bank. So look at this as a strategy. So typically you bill at the first of every month. So at the 1st of October, you bill instead around the 10th of October. That pushes your collection cycle out by about 10 days. So instead of your people paying you on the 1st of November, they pay you the 10th of November. Then the 1st of November, when you would have billed, now you bill around the 20th of November. So now that pushes your sales out into December, and it moves your collections further out. So maybe some of these people who are going to pay you will now wait and pay you in January. So you've effectively moved that taxable income into the next year. Oh, but Kep, what about this? That's gonna make my financial statements look bad. It's gonna look like I don't have much in the way of sales. Well, the fact of the matter is, then on December 31st, you bill everything you can. So from an accrual standpoint, which is the way your financial statement should be, you're gonna have high sales, high profits, but your tax bite is gonna come next year because you deferred the collections. So let's talk about another thing. What about my expenses? Now I understand you think, well, I can pay a year's rent in advance. I'll deduct it all this year. I'm sorry, the IRS is wise to that game. You can't do that, okay? But you can make decisions about things that you need to buy. And if you are going to need to buy something, why not buy it in this year if you need the tax deduction? So you lose a little bit of the opportunity cost of that money because you bought it and paid for it in December instead of January, but you were going to use it anyway. And maybe you ought to get cracking on that project that you're going to benefit from this expenditure and not wait and start on that in January. So you can control that as well. I have a client who wanted to buy a tractor and wanted to add something to it. He had a particular kind of device that he was going to add to the tractor. So he bought the tractor in December and he put the device on the tractor in January. So the question is, when was that tractor put in service? That's the IRS term for when can you start depreciating it, or when can you use the 179 write-off. Well, if you make the case that the tractor was put in service in December, then you could take all the deductions this year. If you don't need them this year, then you could make the case that the tractor wasn't put in service until next year when he added that extra device to the tractor. So there are a lot of ways that if you think through the problem of the tax bite and when you want the deduction and when you want the revenue, you can have a lot of control over that. If you figure next year is going to be a year when you're going to have lower profits because you're going to be investing in your business and it's going to cost you money, then why not take some of those deductions this year and deduct them at say a 25% tax rate rather than next year at a 20% tax rate. So all of these things are about planning and making your tax decisions a business decision. We can help you with that. Give us a call. Thanks.